Hello and welcome to Scrolling with Ceazor. Today is Friday, March 27th, 2026. As usual, I've got quite a few tweets lined up for you. As always, though, this is not financial advice. It's just my own pandering and biased hot air. Okay, so let's take a quick look at the charts. First, we've got gold here. Gold has recovered a little bit today. It's up 1.3%, but down 4% yesterday or 2% yesterday. So it's just recovering back into my range, which is okay. I don't know. I was talking yesterday about pulling it and using it as collateral to borrow stablecoins and farm with those instead, but I just didn't do it. And now I don't know. Anyhow, ETH is down today, a good 3 to 4%. I was considering buying yesterday because I listened to the Daily Gwei, and he always shills me quite well, and everything he says is just like, yeah, he's to the moon. But I'm not, if I were to buy here, I wouldn't be selling tomorrow, or for like a 1% increase, I would be buying, hodling, putting it somewhere, getting some yield on it, and blah blah blah. So anyways, that's up. BTC down. I see lots of stuff on the timeline like, BTC's down, what's going on? Screw these KOLs, this kind of stuff, right? But, why is it down? Who knows, right? People exiting, people selling. I think it might have to do a little bit with like Coinbase blocking the Clarity Act again. And, people are just like fed up. Like, when is this going to just get some certainty, a little bit of certainty from these crypto bros? But anyhow, now you do you. Decide if you want to use some dry powder here or not. That's up to you. I don't know what's going to happen. Just make sure you don't, mortgage your house and buy with leverage. Okay, moving on. Usually I go to Pharos and read their daily digest, but I came across this tweet here. I don't know when it was tweeted. It was yesterday. And, after my podcast yesterday. And I kind of want to read through it because it's quite good. Now, this is a platform. There's no money to be made on this thing. There's no token. There's no yield. There's no like deposit. There's not even a wallet connect. It's just a fantastic tool for doing stablecoin research that is being actively developed and added to all the time. So, there might be gaps in it. There might be missing information and stuff like that. And I will talk a little bit about that later. One piece of information that is perhaps missing, but I'm sure Token Bryce will build this up. Now, I don't know if this was produced by Token Bryce, this tweet, or if the Pharaoh's actual AI machine produced it. I don't know, but I'm going to kind of read it, okay? It's a little bit long, so bear with me. I'm sorry. But there's a lot of, good stuff in here to read, okay? Stablecoin research still has real blind spot. Still has a real blind spot. Most people can tell you whether the peg is holding. Far fewer can tell you what is actually holding it up, how fragile the exit really is, or where the risk sits once the surface starts to crack. That gap matters more now because stablecoins are no longer a niche corner of crypto. They are becoming part of the monetary infrastructure, and the way we analyze them needs to reflect that. And yet, a lot of markets still studies them as fairly improvised way. A general dashboard, a Dune query, a few issuer documents, some posts on X, then a rough intuition that one asset feels safer or cleaner than another, fragmented pieces together, and passed down off analysis. That used to be good enough. It's not anymore. Pharaoh started a stablecoin dashboard what it is becoming is something closer to an observatory, one built around a single idea that reading stablecoins properly means reading their structure, not their surface. It is, in a sense, Pharaoh's is less a dashboard than a structural analytical framework for making sense of stablecoin systems. The problem is no longer access to data. There's plenty of it. The problem is it is scattered, poorly framed, and rarely assembled in a way that reflects how these systems actually work. Most tools help you inspect isolated signals. They do far less than help you read the structures underneath them. What that is what Pharaohs is built to do, not simply give you more information. Plenty of tools can do that, but organize the problem differently. Instead of leaving you with disconnected indicators, Pharaohs shows you how those indicators relate to one another. Liquidity, redemption paths, concentration, dependency chains, censorship exposure, stress points. That changes the quality of the analysis. One of the hardest things about stablecoins is their visibility stability. The visible stability often sits on top of hidden fragility. A stablecoin can look calm while leaning on another stablecoin, on a centralized collateral or redemption assumptions that only get tested when the future turns. The surface can look fine up until it doesn't. This is pretty long, I know, I'm sorry. Pharaohs makes those dependencies easier to see, and once you see them, you stop thinking in terms of isolated coins and start thinking in terms of monetary structures layered on top of monetary structures. That is what it means that is also what makes it a new way of reading stablecoin risk, not as a simple question of price stability, but as a question of structure, dependency, liquidity, and control. That is a more serious way to access that simply checking whatever something is trading close to $1. The same goes for liquidity. Peg tells you something, but not the thing that matters the most. The conditions get worse. The real question is whether you can actually exit through which route, with what depth, at what size, and under what constraints. Stablecoins are not just price stable assets. They are claims on a set of exit conditions, and those conditions vary far more than the market likes to admit. Power is another dimension that deserves to be central, not treated as a footnote. If the stablecoin can be frozen, blacklisted, or operationally constrained across multiple chains, that is part of the monetary profile. Pharaohs treats it that way because it's a structural reading of any stablecoin that has a count of who ultimately controls it. Pharaohs is also built to help you see stress building before the break becomes obvious to anyone else. When liquidity quietly thins, concentration rises, redemption assumptions weaken, and the dependency chains stop looking theoretical. That is the point, where a dashboard becomes something more useful. Memory matters too. Broken pegs, failed mechanisms, and stress events are not just history, they are an analytical frame. A market that forgets its failures tends to misread the next version of the same risk. This matters even more because stablecoins no longer form one simple category. They differ by reserve model, collateral type, governance structure, chain environment, reference unit, and use case. Where we are looking at a monetary field that is diversifying in real time. Pharaohs does not replace DeFi Llama, Dune, Issuer, documents, or the role X plays in surfacing information and debate. It fills a different need, helping people read stablecoins as monetary architectures rather than a list of tickers. More precisely, it is emerging as an observability layer for the monetary field that is becoming broader, more heterogeneous, and harder to read through price alone. Price is easy. Structure is harder to read. That is what Pharaohs is built for. Article written by, so there we go, Armin. So anyhow, yeah, that's that. You can check this out. I have read it all in full to you, so you might not need to. But yeah, like, I'm not saying you got to use Pharaohs, and Pharaohs does have a lot of information inside it. It's not a simple tool. Like, if you go to it, you'll be bombarded with it. And no, like, Pharaohs is not. Someone asked me, is Pharaohs sponsoring your channel? No, it's not one of my sponsors. I just love it because I know what its purpose is. I know its ethos. It's not trying to tell you what to do. It's trying to give you all the information so you can make better educated decisions, especially on stablecoins, because people don't think a lot about like simple things. Like something simple like exit liquidity is so fantastically important. Like if you hold a stablecoin and you can't get out of it, then it's not a stablecoin. If it loses peg, you are the wrecked. You are holding a bag. So check it out. I don't want to dwell too much on it. Like I don't want to shill the crap out of it, but like I'm going to continue to use it, and I'm going to continue to share it with you every day, or at least almost every day. And that's it. So let's move on to some news in crypto and so forth. Okay, so the first one here, I have a Carbon DeFi. Now, I'm a long time user of Carbon DeFi. I really like this protocol for providing liquidity. I'm going to open it up here. And basically, they do have some news. Now, it's criminal that there's only like $500,000 on this protocol. I am a long-term, liquidity provider lover, and the tools that this thing gives you is just so good. I use it only on mainnet, but you can now use it on Celo chain or Kati chain, which today I learned what Kati chain is. You can use it there and you can get extra rewards. So the pools are incentivized on these chains. Again, I haven't done much research on these two chains and whether or not I want to move stablecoins there and use Carbon there. However, I feel like I gotta share it because it's so good, it's so useful. The tools inside are so fantastic, and just give it a try and see if you like it, and that's it. Okay, but moving on to the next one. So here we have 0x farmed. He was retweeted by Protocol FX. He's like, don't become part of this, just use Protocol FX. So just in, Bitcoin crashes below 67,000, over 115 million in BTC longs wiped out in the past hour. So yeah, so when I showed you this little candle here, this apparently wiped out that much. Like, to me, it's crazy. Like if you look at this picture, right? Let me go back to it. So you look at this picture, it's obviously in the minute time frame or something, maybe 15 minutes or something like that. And you just see the bottom falling out, right? But when you look at this chart, it hasn't even it's just basically gone back down to what would be support line. So who the heck put 100 million, which people put $100 million longs leverage with liquidation prices around here, around this point? Like, that's just so degen. Of course you're going to get liquidated. Like I wouldn't do any leverage long with a liquidation price anywhere near the bottom of this candle over here. I would be down around 55 or something down here, right? There's no way I'm going to so I don't know. Yeah, you do you. I guess that's why I'm still here shilling. I'm still here, spitting words and grinding away my APRs and stuff like that because I don't take these kinds of risks. But anyhow, that's that. Now, why did he share Protocol FX? Because Protocol FX has soft liquidation protection. You can long stuff there and not get liquidated very easily. Okay, moving on. Figio, I don't know how to say his name. But anyways, let's read what he says. Friendly reminder that Tempo, ARC, and other corp chains are not blockchains. He says no, but anyhow, I know what he means. Not blockchains. No permissionlessness, no credible neutrality, worse security than PayPal. If you want to sue them, it's even more complicated. And now is a reminder that any permissioned network or payment or security or whatever a single unregulated entity has the power to halt or revert the chain can steal and destroy your assets, censor, change your smart contract code, and break atomicity. So think about it, okay? Like if you want to you want to send your tokens over to Tempo or any of these suit chains, then by all means do so. That's for you to decide, but know that you are basically sending your money into a company's server and hoping that they don't screw up and that you can chase them down. Now, I had this thought yesterday about, the Stream XUSD debacle and the Resolve SUR thing. Now, I had this thought yesterday about this when I was like kind of laying in bed, and there is one silver lining to these guys fucking up so badly, and that is that they're all doxed companies that can be sued. Now, suing takes a shitload of time, and then you get bankruptcy lawyers in there, and they take their huge cut, right? Like we saw what happened to FTX. Bankruptcy lawyers came in and just like cleaned house. Took like hundreds of millions of dollars basically and gave the pennies back to the people, or still haven't given the pennies back to the people. So anyhow, think about that, okay, when you decide to send some assets somewhere. Now, I'm not saying you shouldn't go there. There might be farming opportunities. There might be, APR. There might be speculative opportunities, and maybe you're okay, but just don't send your whole bag to a corporate train, okay? Moving on. So here we have Hey Anon. It says swap MCP. Hey Anon, your AI agent can now find the highest liquidity, lowest slippage, and best routing. So it's like a DEX aggregator for your AI agent. You just need to plug into it. So Hey Anon is like, I see them pushing a lot. They are pushing a lot of code and tech to give people the ability to set up their AI agents to do things. Now, it's kind of outside my wheelhouse. Like I said, I like to click buttons. I don't want to give my money to an AI agent. However, I really should. I really should play with it a little bit more. Or maybe I'll get on a podcast or something, or a live stream with one of these guys and let them shill me and set up an AI agent. But I'm not sure. I think now they're kind of transitioning away from, you can go use our AI agent, and more like we're going to build some infrastructure for AI agents to plug into. And then so they would be like, hey, no point giving us a call until you have a Mac Mini set up with a Cloud bot or something, and then I'll teach you how to plug him into this. Now, does this cost anything? I don't know. You probably, I think you plug an AI agent into anything, it's going to cost you something, right? But yeah, being able to like market buy on all the EVMs, Solana, TON, do limit and buy orders, dollar cost averaging, and all using the standard X402 and ERC 8004 and so forth, and their API. So anyways, check it out if you are using AI. Okay, over to Pandora, which is the other side of this. So Pandora, the devs have been working hard at work. Pandora Parlays UI has been updated. In case you don't know what it is, Parlay is like a way to kind of bet on multiple things at the same time. I really have to dig a little bit deeper than it. Like it's a prediction market, right? It's using prediction markets, but it allows you to then like, kind of like making all the contracts, like all your transactions into a single atomic transaction. It's kind of that, but it also like uses AI to like give you like make sure you're hedging yourself in a way. Like you're not betting heavy on one side and gonna get wrecked. So check it out. It's worth playing around with if you are a prediction market user, or aka gambler, and you like to play with these things. Check this out. I believe that this thing is plugged into Polymarket only, but it might now be plugged into Hey Anon. Oh, sorry, this is Pandora.ai. So there's a site here. You can click it, go play with it, and find out if this is something interesting to you. Okay, so here we have a pretty interesting tweet by Morpho. So Morpho says, Morpho helps tokenize real estate equity becoming productive assets on chain, enabling by Birch Hill Holdings and Groma. Groma coin can now be used as collateral on Morpho with liquidity supplied by Yearn Finance curated stablecoin vaults. So I had to dig a little bit deeper. I read through this article, and I will share it, of course, and you can kind of go through it. It's pretty interesting. So I had to kind of like re-educate myself on what is a REIT. So it's basically some sort of real estate investment token. Not token, but I can't remember what it stands for. The real estate investment trust. Yeah, trust. So basically what we have here is we've got like tokenized real estate holdings. So apparently this Groma coin is backed by a whole bunch of real estate in and around the Boston area. So it's like properties and cash and equivalents. So it's got like 80% cash and a bunch of properties. So this Groma coin is backed by these investment holdings. Now, where does Yearn come into it? Basically, Yearn is running the stablecoin vault. So if you are a USDC provider, you could go to the Morpho front end or the Birch Hill front end, and you could supply USDC to these vaults and lend to people who use this Groma coin as collateral to borrow your USDC, if that's something you want to do. Now, it's just a Yearn vault, so it's basically using Yearn's tech and Morpho's tech, and they're working together with these guys to provide this opportunity to both sides of this trade or this deal. Okay. Now, there is some KYC in here. You'll have to, if you are interested in using this, there likely be some KYC, especially if you're using the front end on Birch Hill. Now, I'm not sure if your lender needs to KYC. I didn't and whether or not, like, if you go to Morpho, you could probably just lend permissionlessly. But you definitely, if you want to probably you want to mint some of these Groma coins, you're going to need some KYC-ish. Okay, so you can check this out. I think it's pretty good. I like that it's on Morpho because it is isolated. It's not like you deposit into a Yearn vault and you don't even know, but now some of your Yearn your tokens are being lent to some, suit coin, for lack of a better word. But I do like that, teams are working with native DeFi teams to build products for individual users and isolating those products in their own little silo to allow for those opportunities to come to chain, but to keep them from contaminating all of the other stuff that's out there. If you want to call it contamination, maybe that's a harsh word for what's happening here. But anyways, I think I would share it, and you do you, and check it out and find out if this is something you want to play around with. Okay, so here we have Millie. I love Millie. I love ZeroX, Not Gonna Make It. They're both great guys. I haven't met either of them in real life, but I've talked to them a lot. And here they are kind of talking to each other on X, and what they have to say is important. Okay, so I'm going to read Millie's first, and then I'll go in and read ZeroX Not Gonna Make It's response to Millie. Millie's retweeting ZeroX Not Gonna Make It, a DeFi llama. Okay, so Not Gonna Make It is one of the most honest, well-intentioned, kind, humble, and pure builders in the space. Not to mention, he's a real cyberpunk who actually practices it instead of LARPing about it. He's an Anon founder who's built many free open source tools, all of them on Ethereum. He's built the most widely used open source crypto data tool, DeFi Llama, right? He is one of the most well-versed people in crypto with unprecedented context, and all that's happened and happening in the industry due to DeFi Llama. Milady culture is not cyberpunk. Sorry to break it to you all. ZeroX Not Gonna Make It is true cyberpunk. DeFi Llama is the embodiment of Ethereum values. Put some effing respect on his name. I agree with him completely. If you don't know who he is, he's just exactly what Millie has described. Now I've opened up what he says. And ZeroX Not Gonna Make It is basically replying to somebody, right? So there's this long talk about Milady's. Anyway, so what does he say? I'm not the founder of Tubby Cats. I deeply dislike how a common deflection is an attack on me instead of engaging with the content. So Davishna Mehta, I don't know. Sorry, I blew up his name. He's a Milady, and he's like, thanks for sharing, Cami. Response: as a fellow journalist to each claim, but the TLDR is Nazi grooming anorexia cult is a good story, but unsupported by facts. First off, the important disclosure wasn't made by 0x Not Gonna Make It, that he was a founder at the time of completing the NFT product. So what is this? Mega thread on My Lady and its founders. So yeah, dig a little bit deeper. I don't know, man. I don't want to dig too much into this, like this culture argument and stuff. I don't even hold any NFTs, really. Like I don't hold any of these NFTs. And it kind of comes across as like, hey, a shill for someone's NFT. But I don't know. You dig deeper. But yeah, 0x Not Gonna Make It is not extracting people's money. Like he's been running DeFi Llamas for as long as I've been like checking out DeFi for maybe not as long, but it grew out of like the same time as when I came around, and he's always just been like super good. And sometimes I DM him, but not too much because I only DM like when I have specific needs. And he's always super respectful and super cooperative. Anyhow, so check it out. Basically, TLDR, no, 0x Not Gonna Make It did not make Tubby Cats. So whoever said they did, then he didn't. Okay, moving on back to stable coins. Here we have Frax Finance. Frax went on the roll up and talked a lot with these guys. You can watch the full episode over there. It's a good show. I kind of blocked one of them a little while ago because he shilled something. I don't know what it was. I can't remember. I think it was Trump coin or something. He was shilling some or some coin. Like he kind of hid the shill, but like he didn't say like, hey, buy this coin, right? But he was more like, hey, look at this coin. Look what's happening with this coin. Here's a chart, and is it going to go to the moon? But I don't know. So I should probably unblock him. Anyhow, because let's talk about what Frax Finance says here. Okay, on today's Frax Finance show, our founder and CEO Sam Kazemian breaks down the two Clarity stablecoin winners: Tether, which doesn't pay yield, and DeFi native stablecoins like FRX which already offers activity-based rewards to our DeFi partners like PegKeepers and Aave and etc. So the Clarity Act has some problems. The main idea here is that stablecoin issuers cannot just issue yield to people who hold stablecoins. That's what the Clarity Act is trying to stop, or that's what's holding the Clarity Act up. And basically, some people want that ability, and other people don't want that ability. But the point is, let's say we secede that ability, Frax USD will still continue to provide yield because it doesn't provide yield to people who simply hold stablecoins. It provides extra boosted yield to people who put those stablecoins to work. And that's the key factor. Like if you put it into different places, then you will get yield, and you will get additional yield from their treasury holdings and so forth. Okay, so that's the key aspect. Now, I really like this in the sense that this whole thing about, there's a whole lot of things about the differentiation of corporate stable coins and DeFi native stable coins. And Frax USD is kind of in the middle of those two. It's a little bit of, it's a strange one. You have to really dig deep, but there's a long, rich history of structural changes to it. So you kind of have to you can look at the history of what it has done through, but you really have to pay attention to its current status and current build, which is no longer, like in the past it was completely backed by USDC, and now it's not. So you have to kind of understand that. Okay, so check it out. Maybe I'll do a catch-up video where I kind of get people up to date on what is the current status of Frax USD and what's going on with there. But it's a little bit hard. Yeah, so anyhow, let's move on. Okay, here we have Ramses. So they did some numbers, and they got some pretty sweet yield on Hype, if that's what you're doing. I hold Hype. I still hold Hype for my airdrop. I have it in this one of these liquidity pools. Yesterday, it was bouncing around in the range around the middle, so I pulled out some of my stable coins because I don't want USDC sitting below price, just waiting to buy back the dip. So I pulled out some of the below USDC and rebalanced and put that USDC to work elsewhere. I don't want my stable coins in there, but like just sitting there waiting to buy. I want yield on my stable coins. So anyhow, I can explain that in more depth somewhere else, some other time. If you don't understand what I'm talking about, you can DM me and I'll try to explain it to you. Okay, liquidity. Liquidity, this is important. If you do have a liquidity trove open up, the ARM delegate is no longer being maintained and has been removed from the front end. So if you are using the ARM delegate, then you need to come to liquidity and change your delegate or undelegate to yourself and manage your interest rate by yourself. Okay, this is quite important. Please move your position to a new delegate within 30 days. After 30 days, the ARM delegate will most likely be completely turned off and stop rebalancing your APR. So you have to fix this. You'll probably be fine, but your interest rate will not match or follow the market and what people are doing. So you might end up being redeemed, or you might end up paying way more than you should be. Okay, so check it out. Moving on. So you have Gabriel Sapiro, Lex Node. He's got I'll put a little bit of a long post here, but I'll read some of it to you. So he says, although I don't feel like an OG, class of 2016, 2017-ish, I guess to many of you, I am, so let me give you some OG advice. Okay, now before I get into his advice, I do want to talk about what is OG. I think most of the people from 2016, 2017 are kind of retired. It's pretty like those people who bought, Bitcoin and Ethereum in 2016, 2017. They got the full like DeFi summer. They were all in on that. They had big bags of ETH already, big bags of like Bitcoin, and they played. And as long as they didn't get wrecked and lose it all, like put all their stable coins in Luna or something or on FTX, then they're probably retired. So I think the current OG status on crypto Twitter goes to the people from DeFi Summer who kind of came in on DeFi Summer. I don't want to say me, but yeah, me. I came in DeFi Summer. I was hesitant. I didn't go all in. I went in comfortably, made a very good growth of my crypto portfolio because of DeFi Summer and so forth. And then, so let's see what advice he has. So I think he is OG status because OG, those OG people, they come around once in a while, they do a little tweet, and they're not active every day. They're not all over Twitter commenting and giving advice and helping people like Gabriel is trying to do right here. Okay, so there's a huge enterprise blockchain and tokenization pushing starting in 2017, getting a lot of attention in 2018-19 bear market. Some ideas good, some bad. And the fact that is real people like Antonop feeling, let's follow him. Antonop feeling that the need to comment on YouTube's channel. So, I don't know what this blockchain versus bullshit thoughts of the future of money. So let's see if he's got some good advice here. I probably should have read this. There are some legit projects trying to build tokenized enterprise crypto ethos. So I just showed you a good example of that with Yearn and that REIT. For example, there's some more examples. Where is his advice? Basically, it's mostly the same enterprise blockchain people who tried this in 2017, 2009, who were utterly disproven by the market. Ethereum and Bitcoin won, who are now back on the second bite of the apple, while most of them are more interested in credible enterprise blockchain builders from the time moved onto other things. For example, one of the polymath guys became founder of Flashbots. Let's see if he's got his reel. Where's his reel? Less doomerism, more interest. This incumbent upon us who understands that what the real benefits of using blockchains for enterprise are to keep trying to push in the right way. So I don't really know what he's saying. I think, Gabriel, this post is a little bit lacking in your ability to really push what people are saying. But basically, he's saying is that like those corporate guys, the suits, they tried in 2017, 2019. They didn't fail. They didn't succeed, and now they're out here trying again to take mindshare, TVL, and so forth. And just be careful about the difference. Like here's a very good part of it here. Even the fact that they changed the name from enterprise blockchain to institutional blockchain, it is part of the PSYOP. As almost anyone can do enterprise, but institutional meant to convey the idea that only investment bankers can participate. So yeah, like be careful about the PSYOP. I think he's trying basically without name calling. I think he's basically trying to point at like Tempo and stuff like these enterprise chains that are like, oh yeah, we're permissionless, come and use us, right? But their validator set is not permissionless. They're not credibly neutral. I think he's just kind of trying to warn people not to fall for that. Now, like I said before, at the beginning of this podcast, if you want to send some assets over there to get some yield and maybe trade potential hype, maybe there's some hype on some fucking meme coins or some governance coins or something like that, by all means do so, but don't send your whole bag. Don't send a majority of your bag. Just be careful. We've seen it time and time again. These centralized entities fold, they go bankrupt, and what do? They shut everything. They shut the doors and you can't get out, okay? Okay, let's go on. So here we have Michael from Curve Finance. He's retweeting this coin telegraph. So apparently the European Union is at it again, and they're like, they've got this paper. It says, paper challenges whether or not DeFi DAOs are decentralized enough to sit outside MiCA. So should the European Union governance, actual government, be able to control your bags, yes or not? Let's see. If they're decentralized, then perhaps they can't control them. But look, all of these DeFi's DAOs are not decentralized enough. So blah, 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 right? So Michael has a good point. He says, seemingly, Curve Finance was too decentralized to be included in the study, which implies that protocols are not decentralized enough. Anyways, EBCT is always free to reach out for more data and to learn about VE tokenomics when VECB. Now, basically, what we can say here is it's cherry picking, right? Of course, if the European this board, right? I don't know what it is, the EC Commission board. I don't know what that CB stands for, and I don't really care because I don't live in Europe. But basically, of course, they're going to cherry pick and pick the ones that are like, hey, look, bad, 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 bad. They're not going to be bad, but this one's really good, and this one's really good, and this one's really good, but bad, 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 bad. So let's go after these bad guys. They're not going to do that. They're just going to go after the bad guys. They're just going to say, you need us, European people. We need to control this stuff. Look at all the bad. That's all. Of course, they're going to do that. Now, the next tweet talks a little bit more about this. So apparently, Curve is in that paper, right? It's just not, heavily researched and heavily shown, right? The data is not shown quite a bit. It says, how can you write a paper on DAOs and not include Curve Finance because of insufficient data? What does that even mean? Curve is probably the most successful DAO in all of crypto. There's no DAO that I can think of that is even more successful. None. Not a single one. Even Aave doesn't compare to the DAO of Curves. Especially now that Aave Labs basically hijacked the protocol from the DAO. But that's a pretty harsh statement, but I think it's pretty accurate, and it is like a simplification of it. But here, Curve is everything that happens on Curve happens because the DAO votes for it. Everything, even emissions, tokens going I guess you can compare it to a little bit to like Velodrome kind of has this as well, Velodrome and Aerodrome. However, in order to get a gauge on Velodrome and Aerodrome, you have to basically, meet the criteria set by, the DAO, but then ask the team to deploy a gauge. And I believe that's probably the case with Curve as well. I don't know. I wish I really should know, right? But it's like, if you just go to the Curve DAO forum and just take a look at what's going on there. It's like yesterday I saw a post the other day where like there's this market on Llama Land that has like some bad debt, and some rando just posted like, hey, I think the DAO treasury should just repay this bad debt so that we can just carry on and remove that flag and just pay it. It's tiny. Just pay this bad debt and let these people get out. And it's just some random person posting a proposal. It gets talk, maybe it gets put to vote, but it's like it's the biggest DAO in all of crypto, unquestionably. Now I don't even have any of my own voting power because I like to just use Yearn, who has tons of voting power and Boost, right? So anyhow, that's that. So check it out. The token is very cheap now. If that's something you want, if you want to become a DAO participant, you can check that out. Okay, so here we have ETH Raider talking about. Yesterday, I talked a little bit about Sephirim, and he's contrasting Sephirim to Vitalik and saying, look at ETH versus Solana culture. Just one of the many examples. So Vitalik's tweet is, bro, this is wrong. The point of Ethereum is to set us free. So give everybody freedom, right? And then Sephiron's point is, what motivates me personally? First off, I'm doing this for glory. Second, I want to be relevant again. So it's all personal, like greed, narcissism, or whatever it happens to be. Anyhow, so it's basically on his news that yesterday, Ethereum's dead. I'm going to Solana. So yeah, anyhow, you can decide what you think is right and wrong. It's pretty clear what I think. I don't think I need to echo it very much. Let's just move on. Okay, so this is something that I want to talk about. So I did this post yesterday. I read by 0x Product, or at least my clips. So I read this article, and it's pretty good. I should probably talk a little bit about that before I talk about what's going on below it here. And it's basically an article by 0x.org that talks about these proprietary AMMs and how they're able to extract money from traders quite aggressively. And it has to do with the fact that they can change the situation in the AMM based on trading trades that come in. So when a good example here, you read through the article and you can also read through these snippets I have, but like just listen to this, okay? No. Yeah. So the prop operators publish an attractive price in the last flash box of each block, then reprice worse for the first flash box of each block. Aggregators snapshot the attractive price. Traders settle at the reprice level. So they say, oh, this is the price on our liquidity pool at the end of the block, right? And that's the price that the aggregators look at. But then they change the price at the start of the block, and then people who trade get the price through the block, and then at the end of the block they fix it. It's just now like that. It's pretty complicated and technical and stuff like that, but it's obvious extractions, right? And there's several examples in this article about how this stuff is being done. These kind of extraction things are being done on these proprietary AMAs. So know what you're doing. Check things out. Basically set your slippage as tight as possible. Just don't, like, you're gonna lose. They're gonna take from you no matter what. Just set it as little as possible, as small as possible, and your slippage, and take the little mini rape instead of the big rape. Okay. So now, what do I want to talk about? I want to talk about this guy here. His name's Crombet. So he replies to me. He replies to my post. He's just, maybe follow equals follow, mate. And I'm like, what? He's like, just meant we can follow FB here. And I'm like, you want me to follow you because you followed me? If you want, mate, we can follow each other and run here. I feel like this guy's like, he's posting to me, asking me to follow him because he followed me. I don't want to follow him because he asked. If he's just like, reply to me, engage with me, give me thoughts, give me ideas. Like you see me when I do this like podcast, I follow people all the time. Like right here, follow back. I'm going to click them because I know they did a sweet article on like proprietary extraction shenanigans. So yeah, and I just hadn't followed them, but now I'm going to follow them back. But like this guy I don't want to follow simply because he's like, hey, we should follow each other. And like he's got 11,000 followers. I have, 17,000 followers. But that's because he's running around just saying, hey, follow me back. And if you look at his followers, I don't want to really dig deep in here, but let me see if I see any followers in here that I can recognize. Yeah, I don't recognize any of these people. Verified followers, there's only a tiny bit of verified followers. Followers, I don't know who these people are, but apparently I know them. Oh, this guy, I know him. And followers, and then you just go through this, and it's just like, I don't recognize most of these people. But like, produce content. That's all you have to do. Like, reply to me, talk to me, give me ideas, share, discuss, but don't just, hey, I followed you, follow me back. I'm not going to do this, right? It's just, I feel like it's grifty and shady and just yuck, right? So I'm sorry, comrade, but I'm not going to follow you because you followed me. Now, I could go into his profile, check out let's check out what he's got here. So he's got a Polymarket, Hyper. He's got a bunch of logos here. He's got XC level for B2B and B2C gaming companies, private consultant currently exploring crypto and prediction space. He's got his LinkedIn. What's this? Building one of the most followed IGPM accounts on crypto Twitter. So that's how he's doing it. He's just going around asking people to follow him. Glad to see Polycool app is leveling up. I don't know who Polycool app is. He's talking about Kalshi, which I know. Polycool app, Polymarket. I don't know. Maybe he's trying to build up an influence so he can get paid to tweet about things. A Siren token. What's Siren token? 3 billion market cap. Siren token. Look at the chart. Like it's a brand new chart. Anyhow, so yeah, I don't know, man. I feel like this is kind of something that's wrong with crypto. Now he does kind of come across as a real person, like which is an improvement on at least he's not a bot, right? Which I don't know, but I'm not gonna follow him because he asks me to follow him because he followed me. I produce content that I like, I see it, and for sure I'll follow you. It's as simple as that. Because I want you to produce more content. I don't want you to go around and ask people to follow you and then build up a following and then start shilling crap on people. Like, I'm sorry. Anyhow, let's move on. So here we have Llama on the brink, Millie. So pump. So he's showing the pump chart. Pump. Yesterday I found out I still have this pump chart on my deck screener. But anyhow, yeah. So anyways, let's take a look at what it says here. So pump the Shillfluencer VC darling has achieved product market fit and P2P rugs, and which generates $500 million in annualized revenue. It's about to make an all-time new low. The same people that tell you to only raise from VCs until you found product market fit do not have a coherent answer for this. Goodbye. Yeah, I don't really. This last sentence is a little bit vague to me. I don't quite understand exactly what he means. But like we do understand that Pump Fund is a pure extraction engine. It's in terrible scalping. It's like a huge meat grinder for anyone who plays with it. And, they extracted hundreds of millions of dollars. Then they tokenized, and obviously they continue to extract because like no one's buying the coin. There's no inflation. Like, why isn't it only up? It's like there's constant buybacks, like with all of this like $1 billion annualized revenue. Why is it not pumping like crazy? Because they gave insiders shit tons of them, or they, insiders sold them. I don't know. I don't even know how Pump Fund got into the market, but it's obvious, like, and maybe it's the fact that this annualized revenue is front loaded and now there's very little annualized revenue. Maybe that's the case. So this chart might actually be a chart of actual revenue generation, like a good appearance of what is generating revenue, like a long time. Like last year it was generating shit tons and now it's just eking along. Now everything is as well. Like if you look at most stuff in the market, the revenue is degrading. Now there are some key things out there that are not like that are sustainable and still generating nice bags of revenue. I don't want to list them all because that's like financial advice, so to speak. So do some research and just find that out. But there are protocols out there that are still generating decent sized revenues now, but they're obviously down from before because there's just less people, less activity, less trading, less everything, right? And more efficient revenue generation vehicles, and people are being protected more. So that like a protocol like Pump Fund has no protection almost for people, and they extract shit tons of money from people from sandwiching them, and now I'm not sure if that's part of the revenue engine, but it's still part of the revenue of the protocol, right? And of course, if the KOLs cannot extract from the plebs, then they're not shilling it as much, and then the revenue is decreasing because of that. So anyhow, let's move on. Let's see what else we have here. So here we have Eli 5. He's talking about Moonwell. So apparently someone tried to hack Moonwell. So you can read through this whole thing. But basically, someone spent $1,000 trying to steal $1 million from Moonwell. They almost pulled it off. Not with a smart contract exploit, not with a bridge hack, with a governance vote. So these governance votes are still happening. I remember there's a protocol in 2020, 2021 or something like that. It's called Bean Money. And it was fantastic fun. It was just like pure Ponzi, like just awesome. I don't want to call it Ponzi, but like that's a way oversimplification. You can check my videos and you'll see what it did. It was just fantastic, big brain, like an algorithmic stable coin. It was so cool, and it was just burning, minting, and it was just purely like more and more people, the more and more utility, the more and more use it got. The burr was just crazy, right? And then they got hacked from this exact stuff. Someone governance hacked it, and it had on-chain governance deployment. So, if the governance proposal were to pass, then it automatically on-chain made changes, and that's why it got hacked. Now, I'm not sure if Moonwell has this or not, and I think it's kind of at the point now where, no, we can't do that until we're 100% sure. And you'll see that, like I said before, you want a new gauge on Curve or Velodrome, you do a proposal, it goes through the DAO decides, and then some humans execute the intent of that DAO. Now, there is obviously, because this is obviously a case, so you can read through it, but like, let's say the attacker buys a whole bunch of these FAM tokens for Mover at a cheap price, proposes protocol recovery, admin mitigation, title cloned, legitimate, so self votes pass quorum with purchased tokens, total time 11 minutes. If executed, admin controls of 7 lending markets, the comptroller and Oracle transfers to the attacker controlled contract with a pre-coded drain. So Yeah, there you go. So you can read through it, find out why it didn't happen or why it couldn't happen. But I think we're at the point right now in crypto where we can't have fully automated governance. It has to be human verified and so forth. So things like this don't happen. And now, of course, there will be a huge discussion about this. Like, people will be like, hey, it's not fair. Like, a vote is a vote, and you have to do the will of the people, right? But when you have, like, hundreds or thousands of people saying, yeah, obviously this is an attack. He financially bought voting power, and then he's pushing through this kind of attack proposal. Then obviously, like, you can just null it, right? But anyhow, moving on. So crypto, so FX Protocol retweets this. So they said USDC and USDT are safe, but they lied. Another 1.1 hidden in USDT. Total frozen stablecoins now 3.2 billion. Your money can be seized and burned forever. This is financial tyranny. FXUSD, decentralized dollar. No blacklists, no single point of failure. Take control of before it's your wallet they burn. Now that's a bit hyperbole, maybe, but you know, in the past like couple weeks, what we've seen was USDC froze a whole bunch of wallets, and then they started unfreezing them. So we saw that happen. The Tether has been, you know, well known to freeze wallets, but apparently they had some other, like if you open this up, right? So before we thought they had frozen around 2 billion, but now it's like 3 billion. And basically what it says here, let me read through it. So it says, we dug into Tron and ETH smart contracts and found something brutal. Tether doesn't just freeze your funds. They actively seize and burn them. Destroyed black funds. On-chain balance shows zero, masking the actual seizure. So basically what they were doing before, people were doing like, oh, they can only freeze those tokens, so we can monitor that money and give you a clear indicator of how much tokens have been frozen. However, it's been discovered that not only can they freeze them, but they can actually burn them. So they have burned like 1 billion plus 1.1 billion tokens that were not counted for is the total burn amount or the total blacklist amount, right? So they blacklist them and then burn them and then maybe remint them somewhere else. I don't know. But anyhow, you can check that out. Know your stable coins. Now, you know, USDT has had a pretty good record of reacting to hacks. So people, when hackers hack and they steal USDT, Tether has been pretty good at like then being very quick to blacklist those people because they can unblacklist them, right? You can blacklist and then be like, see like blacklist first and then see what's going on and then unblacklist if it was actually a legitimate withdrawal or something like that. Now, like, of course, like they're not just going to blacklist every big withdrawal, but like, you know, if it seems suspicious at all, and now with like AI and monitoring technology and just algorithms that can check stuff, it's pretty easy for them to just be like right away, boom, yeah, that's suspicious, let's blacklist it. And then do some research and be like, okay, sorry, dude, here, we're going to unblacklist you, but you know, what you did was suspicious. Look what you did. And okay, it's legitimate, but it didn't look legitimate. So, you know, we blacklisted it, but you're good. Here's your money back. You know, we unfroze it. Now, is that something you want with all of your stablecoins? Of course not. Like there's the trustless force where you want the ability that the tokens can never be frozen. However, you know, sometimes stuff gets stolen. So there's a moral question here. Like, should we allow this to happen? Do we want this? Is this bad? Now, I live in Canada, and the Canadian government froze people's bank accounts because they were protesting and they didn't want like COVID shot. And they froze people's bank accounts of people who sent those people money so that they could buy food. Those protesters don't have money. I'm going to send them some money, so the government freezes my money, right? So like that happened in Canada, and now would Tether, freeze my USDT if I say something bad about the Canadian government or I don't get my COVID shot, right? I don't know. I don't know what they do, but should I accept that as a possibility? That's up to you. That's up to everybody, individual, right? I highly suggest you consider other stable coins, but like any of them from the Trustless Force. The Trustless Force, just go to search Trustless Force on crypto Twitter. It's like a pinkish explosion type thing. You go there. There are 3 right now, and there are probably more that should be added, but right now there are CRV-USD, Bold Liquidity, Bold Stablecoin, and FXUSD. There are 3 stablecoins that are trustless. They can't freeze your coins, okay? And they're backed by, ETH and WBTC and stuff like crypto, not backed by, bank deposits. Anyhow, so you can check those out. Decide what you want to use. I use both. To be completely honest, I think I'm okay. I'm not super rich, so maybe I kind of can fly under the radar. But anyhow, let's move on. Here we have Don.eth. He's like, how USDT is moved across chains, counterparty risk vary widely across tokens. Even though all are supposed to represent the same asset, are users even aware of these risks? Should we make this dashboard public? I'm going to just say yes, please, to Don.eth. Yes, please. And I'm following him already. No, I'm not. Okay, so anyway, so I click through here. So L2Beat, head of research at L2Beat. So he's got this like thing, this chart here that shows like how if you go to different places, where does your stable coin, your USDT, where is it coming from? Okay, so for example, USDT on Ethereum is the main one, right? But if you were to go to Arbitrum, then your USDT is not from Ethereum. It goes to Abstract Chain, and then from Abstract Chain goes to BSC, and then goes to Arbitrum through this wormhole. So this is pretty cool. I like this thing, and I've got it up here if you're only listening and you can't see it. But I think this is pretty interesting. Like, what you want is only these one-way bridges, whether it be the Linea bridge, D-bridge, Avalanche bridge, Stargate, layer 0, whatever the bridge is that you use. You want it to go directly to and from Ethereum for the most part. Like look at this one on Base. I didn't know. So if you want to get USDTO on Base, you're basically going first to Optimism, and then from Optimism to all through layer 0 to Base. So yeah, so know your stablecoin and your bridging and how you can kind of get back from those places with your stable coins, if that's something you want to do. This doesn't look too bad though. Like it's definitely something you need to think about, but it's at least there's the biggest hop is 1, 2, 3, 3-point hop. That's the biggest hop. And some of them have multi-directional hops, so you can kind of jump around between Celo, Inc, Ethereum, Base, Optimism. You can jump all through them, different directions through different bridges. So I think it's interesting. Okay, so this was shared yesterday with me. Not particularly directly. I was watching Daily Gwei and I saw this and I'm like, oh, this is pretty cool. It's Hill Dobby's Dune dashboard about ETH staking, and I did a tweet on it. And basically I said, I'm quite happy to see that EtherFi is now top 3 of ETH stakers, and it has 72,000 validators and 2.3 million. And in the past 6 months, it has grown 10%. So it's overtaken Coinbase. And what Daily Gwei Ceazor said about this is because he thinks retail has left a lot. So Binance hasn't had much growth. Coinbase is down 30% in the last 6 months because retail basically left, and Coinbase is expensive. if you want to stake your ETH at Coinbase, you're getting a much lower rate than if you staked it with some other centralized exchange like Kraken or Binance and stuff like that. But just use on-chain stuff. Go to Lido, go to EtherFi. It kind of saddens me that Rocket Pool is way down here. I really like Rocket Pool, but maybe they just don't have the marketing, or the thing about Rocket Pool, like EtherFi has other products, and that makes it super good because people will then go to EtherFi to use the stable coins or the credit card, and then they'll be like, oh, I can also put ETH in here, so I'll stake some ETH in here as well. So that's fantastic. They are OG, and I'm really happy to see that they have grown to the third position. That's fantastic. It really makes me happy. Moving on. Last one, unrelated to crypto tweet. Here we have, I'm not even going to try to, Mon Luigi C. Nasa Suganasagesi. This is so funny. There's this baby who's like, it's just like, mom needed a 2-second break from holding me all day and hands me to dad. And then just the look on the baby's face of like resentment and anger. It's just like, why did you put me in this man's arms? Why are you, and just the eye contact is so good. It's just like, it makes me feel like, makes me think about parenthood. Like, I'm a father of 2 children, and now I don't specifically recall this happening to me, and now I would never, because you can't, the father can't see the baby's face, right? But it totally makes me understand, like, babies are so good. Like, they don't lie, there's no deceit. It's just pure reaction, pure realness. And we lose that as we educate ourselves, as we learn social abilities and learn to interact with other people. We learn how to deceive, how to lie, and some of us learn how to do it very, very well. Some of us learn how to do it too well and become pathological liars, or they lie to themselves even. But most people do it, and why? Why are people lying so much? It's almost all about greed. Now, there's a bit of narcissism in there as well. Like, people want to be important. People want the glory, as Severin says. He wants to be relevant, right? So he lies and makes up shit, right? But babies don't. The look on the baby's face is so good. Just like, you fucking bitch, why did you give me to this man? I'm just gonna cry in his ear until he gives me back. And anyways, so that's that. So that's it for today. I hope this has been interesting and useful. And thank you so much for listening. And goodbye.